Perfect. Thanks.
Hi, everyone. Thanks for joining us today. I'm Emily Marsh from the Greater Concord Chamber of Commerce. Thank you so much for joining this webinar today. We're thrilled to have Checkmate back working with us on a webinar. They actually did their first webinar with us in March 2020. So they were right there at the beginning, helping us get really important information out to businesses and employers in the Greater Concord community. So thank you so much to Josh Robinson and Checkmate for sponsoring today and for most importantly, sharing this info. I do want to let you know to everyone attending today that you can submit questions throughout the presentation. To do that, you're going to use the Q&A portal. You can access that by moving your mouse or tapping your screen, and then simply click on Q&A. And then from there, you can just type in your question. It will only be sent to Josh and me today. We're the only ones who will see your question. So feel free to ask throughout the presentation. Josh may answer some as he goes, may save some for the end. There'll be time for questions at the end as well. So, feel free to ask away. This is your time to get answers. And thank you so much again, Josh, for being here today. I'll let you take it from here.
Thank you, Emily, and good morning, everyone. My name is Josh Robinson. I'm the president and owner here at Checkmate HCM. We are a provider of payroll services and HR technology for customers throughout New Hampshire and beyond. So I'm here this morning to present a program around the Employee Retention Tax Credit and the Paycheck Protection Program Round 2. There are a number of elements to what I'm going to cover. So there's a couple of different components that I'm going to cover kind of individually, and then I'm going to bring it all together at the end. So with that said, I'm going to share my screen and get started here. Okay. So there is my screen, and here we go. Okay. So as I mentioned, Checkmate, we are a provider of payroll services and HR technology. And back at the beginning of the pandemic, I recognized that, like many owners that run a business like mine, I think did, that employers were in a particularly difficult position with the digesting all of this legislation that was being passed and understanding what elements of it applied to your organization, and making sure that you make the right decisions each step along the way to maximize your ability to obtain COVID relief through the provision of tax credits or CARES Act grant money or PPP money, et cetera. And we were operating in a world back at the beginning of the pandemic where you've got CPAs out there which are doing great work for their customers, but also tends to be on the conservative side of things, and oftentimes are kind of I don't want to say that they're slow to get into the new stuff, but they're more conservative with how quickly they will start advising customers on recently passed legislation and things like that. And likewise with lenders, bankers are by their nature, a conservative group, and as well, they were in a position where this PPP program was thrust upon them, and it was done in such a way that they were rushing to get money in people's hands. So you had the lenders that were, oftentimes not unnecessarily like going far out of their way to educate customers on all of the ins and outs of PPP loan forgiveness. And then with the recently passed COVID relief bill, you have a provision that was originally in place that restricted employers that took a PPP loan from obtaining or receiving the Employee Retention Tax Credit in 2020. And that rule came off with the COVID relief bill that passed a couple of weeks ago. And that opened the can, as far as, the opportunities that you have to get additional relief, but also it significantly complicates the way in which you need to process your numbers and keep your records if you are going to pursue the employee retention tax credit. And so that's the premise of the presentation, is to kind of discuss these, to lay out the possibilities for you so that you can understand whether or not this applies to you. And then you can take that knowledge and go to your CPA, have a conversation with them, go to your payroll provider, have a conversation with them, and make sure that you're getting service properly from your from your professional advisors. So that all said, I'm going to dive right in. As Emily mentioned, please do not hesitate to post questions while I'm going. I've already got a handful that have come through, and yep, perfect. Okay, so I'm just taking a quick look at these questions, and yeah, great. Okay. And yes, so first answer to the, well, I think it's the third question, but yes, the slide deck will be available to everybody who's online. And I'm also going to make myself available, if anybody has questions that came up or that you think of after the webinar, you will have my contact info on the last slide, and you are free, please feel free to send me emails directly with questions if I don't cover them here in the presentation. Okay, so to get things started, just here's the agenda, what we're going to cover. This is going to be sort of rapid fire, but at the same time, I am going to do my best to take a paced approach to explaining the details. There's, it's not uber complicated, but it is complex. There are a number of different variables at play that all need to be considered, but each of them taken individually are not actually super complicated. So we're going to go into an intro here in a minute. Then we're going to talk about the COVID-related tax credits separately. We're going to talk about FFCRA, the Employee Retention Tax Credit in 2020, and then same thing in 2021. Then we're going to get into a brief conversation around the round 2 PPP loan details that are important and relevant for you to understand. And then finally, what we're going to do is we're going to put it all together in the context of a couple of case studies, which is going to speak to, okay, so now I can get my employee retention tax credit in 2020, but I've already applied for PPP loan forgiveness. How does that work? And then vice versa, I can now qualify for the employee retention tax credit in 2020. And I have not yet applied for PPP loan forgiveness for round 1. How does that work? And then finally, we're going to spend a few minutes reviewing some COVID-related tax impacts. And then I am going to take a minute to describe some of the services that Checkmate is providing directly to our customers related to the programs that I'm describing in this webinar. And that's not because I'm trying to sell our services. It's because I'm trying to convey to you what you have every reason to expect that your third-party provider would do for you. And I figured the best context of that would be just to give you a quick overview of what our services entail. And then finally, we're going to have some time for Q&A. In order to get there, as I said, the next half hour or so is going to be somewhat rapid fire. I think it will be done in a paced approach where you'll be able to take away as much as possible from this. But like I said, again, if anybody has follow-up questions after the webinar or thinks of a question that you didn't think of during the webinar, you will be able to send me direct correspondence afterwards. So what has happened so far and what is to come? So as of 12/31/2020, the FFCRA technically expired. That was the Families First Coronavirus Response Act, which compelled employers to provide emergency paid sick leave to employees, up to 80 hours of emergency paid sick leave for the employee to either take care of themselves if they were diagnosed with COVID or to take care of a loved one, and up to an additional 10 weeks of emergency FMLA in the event that their child's school is closed. That's FFCRA, that expired as of 12/31. I will get into some details on the COVID relief bill that passed regarding FFCRA in a few minutes. employer Social Security tax deferral option, which was available to companies that did not take PPP loans in 2020, that also expired as of 12/31. The employee Social Security tax deferral option, which was the option that the Trump administration had made available back in the fall, where you could allow your employees to defer their payment of their Social Security tax until 2021. That program also expired as of 12/31. The 2020 Employee Retention Tax Credit also expired as of 12/31. As of the moment, all loans from the first PPP program, the first 2 rounds of PPP funding, all loans were issued. The second round of PPP funding back in, I think it expired in July 31st was the last date on which loans could be issued. That still had, I think, around $200 billion left in it at the time that the program expired. There's now 3 PPP forgiveness applications, including a recently revised, just yesterday, the SBA posted the new version of the 3508S PPP forgiveness form, which is the simplified forgiveness form. And now the 3508S applies for PPP 2 funding, applies to all loans issued that were $150,000 or less. I actually also think that it applies to PPP round 1 funding, now that I'm thinking about it. You should be able to use the 3508S to request forgiveness, even if you are requesting forgiveness on a round 1 PPP loan, if your loan was $150,000 or less. One question that's come up a lot in light of the fact that your employee retention tax credit in 2020, now there's overlap that needs to be taken into account with your PPP loan when you request forgiveness. So the question has come up a lot around how long do we have to request forgiveness? Well, every employer has up until 10 months after the end of your covered period to request forgiveness. If you do not request forgiveness by then you will not be able to obtain it at all. And then finally, the SBA is starting to audit PPP forgiveness applications. We have had a couple of customers now who have needed assistance because the SBA has been working with their lender to audit those forgiveness applications. The way this plays out for loans that are smaller dollar figures is the SBA simply will send the lender a communication saying that they're demanding all documentation that didn't originally need to be provided, but the borrower had attested to the fact that they possess documentation around. For instance, your documentation around wage reductions or FTE counts and things of that nature, which originally didn't need to be provided when you applied for forgiveness. When the SBA is auditing, they're demanding all documentation. Word to the wise, if you do get audited by the SBA will communicate to your lender, the lender will communicate to you. And they are going to indicate that there's urgency here because you have, from the point at which the SBA starts to audit, you have 10 days to provide all documentation in order to satisfy the SBA's audit requirements. So just an FYI, if and when you hear from your lender on this, they are going to be expecting quick response from you because they have a 10-day window to play with there. Finally, for the intro, and then we'll get into the meat of the presentation, what is a refundable payroll tax credit? So the employee retention tax credit right now, as far as I can tell, is a very much underappreciated element of COVID relief that Congress passed here. When Congress passed the COVID relief bill a couple weeks ago, and they removed the restriction that was previously there preventing employers that obtained a PPP loan from taking advantage of the employee retention tax credit, they opened up an opportunity for a large swath of employers to obtain up to $5,000 per employee for the year in 941 refundable tax credits. A 941 refundable tax credit is something that is available to all employers who have payroll. It doesn't matter if you have corporate income tax. It doesn't matter if you are a 501c3. It doesn't matter if you're a 501c6. It doesn't matter if you are profitable or not. It is entirely based on the fact that you have W-2 employees that you pay payroll to. A refundable 941 payroll tax credit means that once the data is processed with the IRS to realize the credit that you're entitled to. So for instance, when we process the 941X for Q2, and it still remains to be seen, we're awaiting guidance from the IRS on exactly how we go about claiming the credit, but 95% chance it will be through the 941X. So we file a 941X in Q2 for Q2 of 2020. For, let's just say you have 20 employees and you experienced a 51% revenue drop in Q2 2020. That means that you would qualify for the employee retention tax credit for the entirety of Q2. Let's say you have 20 employees and $5,000 a pop, $5,000 times 20, that's $100,000 in employee retention tax credits that you're entitled to. We process a 941X indicating that you're entitled to $100,000 in 941 tax credits, and the IRS will recognize the credit on account, and then at some point they'll be looking for guidance on what to do with the credit. Do we roll it over into the next quarter, or do you want us to cut you a check? That is what a 941 refundable payroll tax credit is. So right now, any employer that was forcibly shut down partially or fully due to regulatory authorities last year, or any employer that had more than a 50% revenue drop is entitled to, with some exceptions, is entitled to the employee retention tax credit. So I just want to emphasize what a refundable payroll tax credit is. If you ever hear the words refundable payroll tax credit, that should be, that should be music to your ears, and you should be more than willing to spend a few minutes trying to figure out whether or not you possibly could qualify for that. So FFCRA, this is where we're now, I'm going to cover like 3 different items kind of separately, and then I'm going to bring it all back together when we get into case studies. So FFCRA, the COVID relief bill that was passed a couple of weeks ago, extended into 2021 the option for employers to continue to comply with the FFCRA through 3/31/2021. Oops, sorry. What this means is that any employers that had accrued FFCRA wages as of the end of 2020 that didn't get paid to employees until the beginning of 2021, you still should have been able to receive your fully your 941 tax credit for 100% of the value of the compensation that you had to pay out for FFCRA paid leave, even if the pay dates happened in 2021. Additionally, it means that if you choose to, you can continue to, through 3/31/2021, you can continue to pay your employees for this emergency paid sick leave if you choose to, but you can only do this and receive your 941 tax credit insofar as you adhere to the balances that you were obligated to provide when FFCRA was originally passed back in the spring of 2020. You are not allowed to give any additional hours of emergency paid sick leave to any employees beyond that original balance, but you can still pay on the balances that remain if you choose to. And the way this should be working for you is that in the payroll in which you incur the costs for the FFCRA labor, the 941 tax liability that you incur for that payroll should be reduced dollar for dollar by the FFCRA related costs. And that now does apply through the end of March if you choose to continue to comply with FFCRA. And this is important in the context of the employee retention tax credit, because as you'll see in a few minutes, one of the key factors to keep in mind here is that you cannot double dip. the FFCRA program, already inherently within it, provides you with an immediate credit on the total cost of the labor that you incur on FFCRA wages. Therefore, if you paid employees through with FFCRA wages, you cannot claim the employee retention tax credit on those same wages. So the employee retention tax credit in 2020. So now moving on from FFCRA to the employee retention tax credit in 2020. The way this program works, and was originally defined to work and now does work for employers even if they obtained a PPP loan. The rules are that your organization must have been forced to fully or partially suspend operations during any calendar quarter in 2020 because of governmental orders limiting commerce or group meetings due to COVID-19. And I'll clarify on that. It actually means that you were forced to fully or partially suspend operations on or after March 13th, 2020 through the end of the year. That is one of the prerequisites or one prerequisite that will make you qualified to receive the ERTC in 2020. If you do not qualify because of that reason, then you might qualify due to a significant decline in gross receipts. So what is a significant decline in gross receipts? So the gross receipts test means that the ERTC in 2020 is available to you if the full or partial suspension rule does not apply to you, and you have experienced a significant decline in gross receipts, which would occur on the first day of the first calendar quarter for which your gross receipts are less than 50% of the gross receipts that you received for the same calendar quarter in 2019. So either, in order to get the ERTC in 2020, either you needed to have a full or partial suspension of operations, or you need to have at least a 50% decline in gross receipts from one calendar quarter in 2020, starting 3/13 or later, when compared against the same calendar quarter in 2019. If either of those two situations apply to you, then you qualify for the ERTC in 2020 with some very limited exceptions. There are exceptions around certain types of employers that don't qualify. So when you qualify for the ERTC due to the suspended operations, then it starts on the date of the suspension, and your ERTC eligible period ends on the day that your full or partial suspension of operations ends. And the ERTC is not available on wages that were paid prior to 3/13/2020, no matter what, across the board. So well, what is it exactly? The ERTC, the Employee Retention Tax Credit for 2020, is a refundable payroll tax credit on 50% of the first $10,000 paid to any employee during the eligibility period. Now in 2020, it works differently if you have 100 or more employees versus if you have fewer than 100 employees. So for companies that have 100 or more employees in 2019, the 2020 ERTC is available to you on qualified wages paid during periods of suspended operations on wages that you paid for people to not work. So basically, whatever wages you paid while your operations were suspended, in order for those people to continue to receive income but not work, that is what you can get your ERTC on if you have 100 or more employees in 2019 and you are claiming the ERTC for 2020. You can only count the wages up to the amount that the employee would have been paid for working an equivalent duration during the 30 days immediately preceding the period of economic hardship. So the calculation here is a little complicated for the employers that have 100 or more employees. For those that have less than 100 employees, however, it's very simple. The ERTC applies to all qualified wages paid during the eligibility period up to the threshold of $10,000 per employee for the calendar year 2020. Now, as I said before, there is no double dipping, okay? So if you paid for labor through FFCRA, then you cannot get an employee retention tax credit on that same labor cost. Additionally, if you paid for labor with PPP money, you cannot get the employee retention tax credit on the labor that you paid for with PPP money. Additionally, if you otherwise have received CARES Act grant money from, there's very likely considerations that you need to give to money that you may have received from, say, the LTC Stabilization Fund for nursing homes and other organizations like that. There's very likely considerations that you might need to give to monies that that you receive for various purposes. You know, the Main Street Relief Fund that was done here in New Hampshire is different, because basically the Main Street Relief Fund, the grant money that you receive there is basically revenue, and the payroll costs that you incur or pay for with that money is standard payroll cost that works just, you know, like it would work if it were regular revenue. And you can obtain the employee retention tax credit on payroll costs that you incurred, that you paid for with that kind of grant money, because it is fully taxable revenue, both at the federal and the state level. There are considerations that would need to be given to grant monies received by 501c3 nonprofits, very likely, because the source of the grants, you know, you're going to need to the grant funding for nonprofits has a lot more stringent strings attached to it, and the reporting around that you're going to need to provide to the source of the grant money in order to justify what you spent it on is a lot more severe than it is for the way the Main Street Relief Program worked. So, so that said, again, no double dipping, generally speaking. So it should be pretty straightforward on that concept. Now, it does enormously complicate how do we actually calculate what you're entitled to for the ERTC, but it does not make it impossible by any means. And given the dollars that we're talking about, it is worth taking the time to figure it out. So now before I bring things all together, I'm going to now share details on the employee retention tax credit for 2021. Okay, just checking the time. So the COVID relief bill that passed a couple of weeks ago extended the ERTC through the first 2 quarters of 2021, but not only did it extend the program, it also significantly expanded the program, both in the total dollars available for you to receive and the types of employers that can participate. So originally, the tax credit rate was 50%. It was a 50% credit on the first $10,000 that you paid to any employee. Now the credit is 70% of qualified wages, not 50%. It also lowers the eligibility thresholds for employers to participate. So last year, in order to get the ERTC in any calendar quarter, if you didn't have full or partial suspension of operations, you would have needed to have at least a 50% decline in gross receipts from one calendar quarter compared to the same quarter in the prior year. With the 2021 ERTC, the decline in gross receipts is now 20% or more. It also provides a safe harbor for employers to use the prior quarter gross receipts to determine eligibility. What this means is that there's 2 ways to determine whether or not you qualify for the ERTC in Q1 of 2021. One would be looking at your gross receipts from Q1 of 2021 compared against Q1 of 2019. And if you have a more than 20% reduction, then you qualify for Q1 of 2021. However, you wouldn't know that until the quarter has ended, in which case the only way for us to get the credit would be through the filing of the 941 and whatnot. You could, however, use the safe harbor to determine whether or not you qualify for the ERTC in 2021. And that safe harbor is, if in the preceding calendar quarter, in this case Q4 of 2020, you experienced at least a 20% decline in gross receipts when compared to the same calendar quarter 2019. So again, if Q4 2020 compared to Q4 2019 results in gross receipts that are more than 20% below what they were in 2019, then you could qualify for the ERTC for Q1 of 2021. And this is a big deal because the ERTC money in 2021 is even bigger than it is in even bigger than it was in 2020. So the limit on eligible employee creditable wages is increased from $10,000 per year to $10,000 per quarter. So let's think this through for a second. We've increased the qualified wages, or the credit on the qualified wages, from 50% to 70%. And we've also increased the creditable wages that can be recognized, the threshold, from $10,000 per year to $10,000 per quarter. So if you do the math, if you end up qualifying for the ERTC in 2021 in both quarters, then you stand to receive up to $14,000 per employee in refundable 941 payroll tax credits for the ERTC in 2021. Additionally, the 2021 version of the program increases the threshold that previously determined what qualified wages were from 100 or more employees to 500 plus employees. What that means is that all employers with fewer than 500 employees for the 2021 ERTC can get the ERTC on all wages that you pay any employee up to the threshold, rather than only the wages that you paid those people to not work. Additionally, for 2021, the program has expanded to include public universities, public hospitals, and certain public medical care providers who originally were not allowed to participate in the program in 2020. So we also have, for companies that have 500 or fewer employees, at any point during the quarter, you will be, well, as soon as the IRS revises the form, you will be able to use IRS Form 7200 to request an advance credit from the IRS on the wages that you will incur during the rest of the quarter, but have not yet paid. You can use the Form 7200 to request an advance on those wages, but that advance that you're requesting has to be based on what your total payroll cost was during the same quarter in a previous year. So again, in this case, you could use 2019 or 2020 theoretically to actually request that the IRS advance you $50,000 of ERTC credit money, since you will have generated that amount of credit by the end of the quarter. So that's just something to keep in mind, because otherwise, the processing of these credits, the processing of the credit and the receipt of the credit is going to happen through the filing of a 941 or 941X, which means that at the soonest, you could expect to get your money back from the IRS at the soonest, I would say 60 days after the processing of the return in question. So if your return if your 941X, or rather if your return for Q1 2021 is not processed with IRS until sometime around about April 30th, then it would be at least the end of May, if not later in the year, before you actually got your money back from the IRS, which is why they've created this way to get money in advance. Because again, the whole point here is this is COVID relief. It doesn't do us, many favors here if you're stuck, footing the bill and just getting reimbursed 4 months later. So it also allows employers who are not in existence for all or part of 2019 to be able to claim the credit for 2021, which was something that was a challenge for employers with the 2020 ERTC. All right, so we've got just over 20 minutes left. So I'm going to speed things up just a little bit, guys. But I still think there's plenty of time here for me to cover the rest of this. There's about 15 minutes of core content that I have left to cover. PPP round 2. So as many of you know, the second, PPP 2 is what I'm calling it. It's technically the third round of funding, but PPP 2 reopened for applications on Monday, January 11th to community finance institutions, and it opens for all lenders on Tuesday, January 19th. So now all lenders can issue PPP loans, all lenders that do lending through SBA. PPP borrowers on the second round, you have the opportunity to elect whether or not you're going to use an 8-week covered period or a 24-week covered period or any number of weeks in between. For PPP 2 loans, there are additional things that you can spend your money on, including operations expenditures, which would include in this case payroll processing fees and related fees and HR software license fees, property damage costs, supplier costs, and worker protection expenditures. So one of the things you're going to see at the end is I have just a little link to a website of a company that we've just acquired, well, a few months ago. We bought a couple of super powerful commercial grade air cleaners to have in our office here to help us protect against exposure to COVID in the office. And one of the things you'll see at the end is a link to the website. It's a New Hampshire company that we bought the products from. And if we had bought this equipment with our PPP 2 money, we would actually be able to have paid for it with PPP money instead of having it as a capital expenditure that actually affected our bottom line, if you will. And then 501c6 organizations can participate. So trade associations, chambers of commerce, and certain marketing organizations that fall under the 501c6 designation can now participate in the employee retention, or rather PPP rounds 2. Sorry, I'm getting my programs mixed up here. Additional details for PPP round 2. The eligibility criteria is simply if you're taking a second draw loan, that you need to have or will have used all of your first round PPP money, that you have no more than 300 employees, and that you can demonstrate at least a 25% reduction in gross receipts between comparable quarters in 2019 and 2020. Now, originally, there was some confusion around whether or not you would qualify for PPP second draw loan if you had a 25% or greater reduction in any calendar quarter of 2020, or if you needed to look at the entire year. And the fact of the matter is, based on everything I now know, it's either or. So if you had a quarter that you had a greater than 25% reduction, then you qualify, even if for the whole year, your reduction only came in at 17%. Likewise, well, I don't think that you could come in below at more than 25% below for the year without any calendar quarter being 25% or more below. So in any case, it's either or. If a calendar quarter was more than 25% below, or for the whole year, you're 25% below or more, then you can qualify for a second round PPP loan. However, there's a couple of additional details here to be aware of. This next one is the lenders are processing PPP loan applications more slowly, and they are being more thorough, and many of them are imposing their own rules around what they require in order to approve a PPP second draw loan or even a first draw loan for this PPP2 program. There are numerous lenders now that are requiring, for instance, for you to provide copies of all quarterly tax returns for all quarters of 2020 in order to process your second draw PPP loan request. And there's nothing in the rules about PPP lending that require them to do that. However, they're making their own rules. And if you're going to attempt to obtain a loan through that lender and they've created their own rules, then you're going to have to either, adhere to those rules or find another lender. So putting it all together, case studies. And this is really the core of this presentation. So now, many of you are sitting there saying, okay, well, we might not. But, I'm not sure if it's even worth my time. This is super complicated. I'm not sure if it's even worth my time to figure it out. So I'm going to just walk you through a couple of case studies that might inspire you to, to look into this. The first case study is a restaurant, an employer that is a restaurant that has 50 employees, okay? They took out a PPP1 loan in 2020 for $400,000. They experienced a partial suspension of operations when indoor dining became prohibited due to the lockdown imposed by Governor Sununu in the spring of 2020. And further, their partial suspension of operations, continued, into beyond that because of the rules that were imposed upon them by the government, restricting the capacity, to originally I think it was 25%, then it was bumped up to 50%. But so long as there were rules in place that prevented the restaurant employer from allowing absolutely everybody that could fit into their building up to the fire code in there so that they could service every one of them and generate revenue for every one of them. As long as there were rules in place that prevented that employer from doing that, then they were under a partial suspension of operations. So the total payroll cost for this employer from the first date of partial operations through 12/31/2020 was $1.75 million. They already applied for PPP1 loan forgiveness, and their forgiveness application indicated that 100% of $400,000 was spent on payroll. They experienced a 35% revenue drop in gross receipts between Q4 2020 and Q4 2019. And they paid out $23,000 in FFCRA wages in 2020. So the conclusions here. Firstly, the employee retention tax credit is available, but not on the $400,000 of payroll costs that were paid for with PPP money, or on the $23,000 in FFCRA wages. Okay, so what does that really mean though? So the total ERTC available, assuming that from the point at which the last dollar of PPP money was spent, which let's just say hypothetically this employer had a loan disbursement date of say 4/20/20, which would make their covered period, 24-week period, covered period end sometime around like October 5th or something. But they spent the last dollar of their PPP money on payroll costs sometime around like September 1st. So basically, if this employer, if from September 1st through 12/31, this employer paid at least $7,500 to every individual that worked for them, every one of the 50 people, then they stand to receive 50 times $7,500 of qualified wages times 0.5, or $187,500 in refundable payroll tax credits for, in this case, for Q3 into Q4 of 2020. So again, just talking it through. Employer obtained $400,000 PPP loan. Employer already obtained loan forgiveness. So what we're going to do in that context in order to maximize our ERTC is we would do two things. It's not, one of them is not covered in the slide, but the first thing we would do is we would calculate the ERTC that you're entitled to from the first day of eligibility for ERTC through the date of PPP loan disbursement. So 100% of those wages would be qualified wages for the purposes of the ERTC credit. And then we look at the remainder of the year after you spent your last dime of PPP money through year end or through the end of your eligibility period, and determine how much additional ERTC credit you're entitled to, and correspondingly file the 941Xs to get the credit processed and received by the IRS. So now we're going to look at the exact same example, except the employer had not yet requested loan forgiveness. And I just want to open your eyes to what the possibilities are. Keep in mind, when we had already requested forgiveness, we had $187,500 in refundable payroll tax credits. But what were the possibilities if we hadn't yet requested forgiveness? Oh, and also in this example, the ERTC for Q1 of 2020 is available. Okay, so example 2, restaurant with 50 employees, total PPP loan, $400,000, partial operation suspension due to in-room or in-house dining being restricted. Total payroll costs, $1.75 million. They did not yet apply for PPP-1 loan forgiveness, which means that we can be creative in what we report to the lender on what dollars of our PPP money we're going to say were spent on payroll versus what dollars of our PPP money we are going to say were spent on non-payroll costs. Just gauging my time. So again, this same, it's the identical situation except for the loan forgiveness question. So in this example, the ERTC of course is available as well. However, using a strategy in our loan forgiveness request, we could report things so that it would otherwise appear that wages that we otherwise might have stated were paid for with PPP money were not in fact paid for with PPP money, by instead claiming that 40% of our PPP money was spent on non-payroll costs. Now, of course, that does mean that if you're going to report 40% of your PPP money spent on non-payroll costs, you're going to have to produce bank statements and utility bills and rental agreements, all of this documentation. However, let's see how much money's on the line to justify, having to, gather up all of that documentation. So in this example, if we assume that all employees were paid at least $10,000 from the date of suspended operations, which would, in the case of the New Hampshire restrictions that were imposed on employers, I think it was like March 17th or 18th. As long as this employer spent at least $10,000 per person between March 17th or 18th through the end of the year, then they are entitled to 50 times 10,000, which is 500,000 times 0.5, which is a $250,000 refundable payroll tax credit. And I suspect that it's worth $67,500 to gather up the utility bills and the rental statements and all of the other documentation that you would need in order to justify the 40% of your money that was spent on non-payroll costs. So that is the mission of my presentation, to convey these details to you and the possibilities that exist with the ERTC now being available to you in 2020, and to encourage you to really think about whether or not you qualify for the ERTC in 2021. I know we're getting down to the wire and I've got some Q&A to get into, and I am going to end with at least 5 minutes to spare so that Emily can share some news with the group. So just bear with me now as I'm going to go into answer some questions before I cover my last couple of slides. Okay, so yes, okay. So I think I covered the ability for somebody who already submitted their PPP forgiveness application, but again, I'll just explain that logic one more time. The easiest way for you to obtain your ERTC if you've already applied for forgiveness would be to say, okay, we can get full forgiveness, or rather full ERTC available to us on the span of time where we qualified prior to when our PPP loan was dispersed. And then we can get the difference between that credit amount and whatever else we would be entitled to up to that threshold for the span of time during the eligible period after we spent the last dime of PPP money and until the end of that eligible period. And as long as doing it that way, as long as we can get, you know, the $10,000 wage threshold reached for each person on staff, then we will have maximized our ERTC. Theoretically speaking, though, you can get the employee retention tax credit on an employee by employee basis. You can pick and choose which payrolls in which you are going to claim that credit on for which employees, which means that during your covered period, if you actually hit the threshold of, for instance, if you have a 24-week covered period, you can't pay any employees more than $46,385 over the covered period and have it forgiven for PPP purposes. So if you hit that $46,385 mark, say on August 8th for that person, but everybody else hadn't hit that threshold yet, then you could start getting ERTC credits on the wages that you paid for that one person from August 8th forward. But it would be enormously complicated for you to document that and keep your record of that. And one of the things that you absolutely have to do when you're claiming this credit is you have got to keep your paper trail. You have got to keep your records. And that is part of the service that we're providing for our customers is making sure that all of the record keeping is completely spot on. So because I don't know for sure yet, there has been no news yet on the intention that the IRS has for increasing the level of audit around the processing of employee retention tax credits. But given the dollars involved, I can't fathom that they are not going to increase the frequency of these audits. So by processing corrected tax returns to claim and get the IRS to cut us a check for $100,000 plus, or whatever that amount might be for you, it is definitely going to be something that very likely might trigger an audit. So we need to make sure that every step along the way, every document that we need to retain to prove our case, to justify our credit, is obtained and accessible so that if they ever come knocking on our doors, we can provide that to them. This is why I say, while you can calculate the ERTC on an employee by employee basis based on when you've spent your last dollar of PPP money on that person, my suggestion would be to look at it kind of cleanly and say, okay, rather than what was the last payroll on which we spent PPP money for an individual, what was the last day on which we spent PPP money for all employees, which would simply be, in the context of already having requested forgiveness, it would be, it wouldn't be the date of the end date of your covered period necessarily, even though that might be what you're reporting. You might report that you spent $150,000 in payroll costs by the end of your covered period when you requested forgiveness, but you actually might have spent, all principal. If your principal was like $88,000, you might have spent that principal well before the end of your covered period. So you would claim the ERTC on all wages that you paid after you spent the $88,000 of PPP money, but not necessarily after the end of your covered period. And that's how I would suggest that you keep it clean, because otherwise you're going to be breaking it down on an employee by employee basis. And, you're certainly welcome to do that as well. But I think that the severity of the audit and your need to be able to prove yourself is just going to be more complicated if you do this analysis on an employee by employee basis. All right, so let's see, other questions here. So yeah, as I said before, the IRS has not issued guidance yet on the exact way that we are claiming the credits for 2020, which means that we don't yet know Again, usually you do these things with a 941X. I can tell you that you are not going to do this through the submission of a Form 7200, because the Form 7200 is a request for a credit, an advance credit on payroll costs that you have not yet incurred. So you cannot process Form 7200 on fully expired quarters that you already filed a 941 for. That is a fact. And it still remains to be seen from the IRS what the exact guidance on processing, to obtain the ERTC for 2020 would be. But I've got 95% certainty that it will be the 941X process. Okay, so yeah, independent contractors. Yes, so PPP round 2 loans are available to independent contractors. The rules on this are covered in the PPP loan application itself. There's like page 3 or 4 kind of describes or gives instructions on how to complete the application, and where it describes how to calculate your average monthly payroll cost, it does include details on how to calculate average monthly payroll costs specifically for independent contractors. And it's basically a reference to your Schedule C filing on a prior year's tax return as your basically evidence of your payroll costs. Unfortunately, for an independent contractor, it does, it's speaking to, in essence, the profit that you earned, as opposed to the, the full cost of compensation that you would have incurred for an owner on payroll. So your variable there for the owner isn't going to be necessarily as generous as it would be for a W-2 employee, but you can do it. And I would recommend that you read the instructions on page 3 or 4 of the application, where it instructs you on how to calculate your average monthly payroll costs. So there's a question in here, which is, must it be 50%? Could it be 25%? I assume that is a question in reference to the declining gross receipts that's necessary to get the ERTC in 2020. And so I'll state the rules just again for everyone to understand. One of 2 things needs to be true for you to qualify for the ERTC in 2020. 1, you need to have experienced at least a 50% decline in gross receipts from one calendar quarter in 2020 compared to the same calendar quarter in 2021, or rather 2019. Or you need to have had a full or partial suspension of operations. The second rule means that if you're a restaurant, if you are a dental practice, if you are a medical practice provider, if you are a retail operation, if you are any of those types of entities that your physical location was forced to close, fully or partially, then you qualify for the ERTC out of the gate. Now, otherwise, if you don't, if you were considered an essential employer, then in order to qualify for 2020 ERTC, chances are you're going to need to be able to justify that with a revenue reduction. But it's not a 25% revenue reduction, it is a 50% revenue reduction for 2020. For 2021, it is a 20% revenue reduction, not a 50% revenue reduction, not a 25% revenue reduction, but 25% would get you there. So is the revenue test for the payroll tax credit based on each quarter or the full year? It's based on any quarter. So in any quarter of 2020, if you had a revenue drop of 50% or more, so let's just imagine Q2 came in at 57% below Q2 of 2019, and then Q3 came in at 400% of Q3 2019. You qualify for the employee retention tax credit because you had a single quarter in the year when you had a more than 50% reduction in revenue. Now, you would only qualify for Q2 in that context because the rule is that your eligibility period ends in the first calendar quarter where your revenues or your receipts have come back to at least 80% of what they were in the prior calendar quarter, or the same calendar quarter in the prior year. So I think I'm down to the wire. I'm sorry. I'm going to pause here.
I'm just chiming in to say I'm going to leave this open for just a couple more minutes, Josh, so that you can get to these questions. If you do have to go, we are recording this, so if your answer gets questioned later, your question gets answered later, and you got to run to a meeting, you can watch it later. So I'm going to keep this open. Josh, you keep going.
Perfect. Okay, so I'm going to keep going. Interesting question. So question is, do you deduct the amount of revenue recorded for the first PPP loan when calculating the 25% reduction each quarter? And the answer to that question is no. Basically, the rules around your 25% reduction each quarter are a reduction in gross receipts. A forgiven PPP loan is revenue. Now, the federal government considers forgiven PPP money to not be taxable for, on the corporate income tax side, but the state of New Hampshire still considers it to be taxable for revenue purposes. And it is for those reasons, you don't remove or disregard your PPP loan money, or at least I didn't when I was doing my analysis. And I have not seen any news that would indicate that you should, which does mean that there are employers out there that could qualify for this, if not for the case that they received the PPP loan. And if the receipt of the PPP loan does make it so that you did not experience a 25% or greater reduction, or rather 50% or greater reduction in each quarter, then it means that you wouldn't qualify for the ERTC. And that's a 50% reduction in each quarter, not a 25% reduction. However, just for clarity, if there's any calendar quarter in the year where you experience the 50% revenue reduction, then you qualify for that quarter and any other quarter up until the quarter that occurs where your receipts are back up to 80% of what they were in the same calendar quarter in the prior year. So if you didn't get back up to 80% for all of 2020, then you qualify for all quarters of 2020 from the point at which you became eligible. So another question is, does the PPP money need to be used first? The answer to the question is no. You need to attest to the fact that you will have spent it in order to apply for and receive a second draw PPP loan, but you do not need to have spent it at the time that you apply for the second draw PPP loan. All right, so if I'm putting this all together, you would be required to spend PPP money before applying for the ERTC. Not quite. Okay, so again, the question is, so if I am pulling this all together correctly, you would be required to spend PPP money before applying for the ERTC. And the answer is not quite. And what I mean by not quite is that you need to, in order to make sure you get all of your PPP money forgiven, you will have needed to spend some of it, but you don't need to have already spent it in order to claim the ERTC. All you need to do is you need to do things in such a way that if the IRS ever audits you on the credits that you've claimed, that you will be able to back up what you claimed for credits with documentation to justify what you obtained in credits. So let me just explain a little bit further on this. You could, going into your payrolls, if you know that you qualify for the ERTC in 2021, then you could do and you obtain a second draw PPP loan. Let's imagine that you obtain a second draw PPP loan for $100,000 and you qualify for the ERTC in 2021. So you could calculate, okay, so I need to spend at least $60,000 of that on payroll. So I need to make sure that at least $60,000 of the wages that I pay my staff during the covered period we do not claim the ERTC on. So then what you would simply do is you would create reporting for yourself so that you can see the second that you spent the $60,000th of that 100,000, and then from that point forward, you can claim the ERTC on everything else, even though you haven't spent the rest of your PPP money yet, because you're spending the rest of that PPP money on non-payroll costs. So that's just, you don't have to have completely spent all of your PPP money before you start claiming your ERTC, but you need to have done the analysis to know, so that you know that the credits you're claiming are legitimate, so that if you ever get audited, this isn't going to come back to bite you in the butt. To qualify for PPP2, do you need to include PPP1 revenue in the quarter comparison for the 25% reduction in revenue? Yes. Well, yes. So yeah, you should, because PPP, the PPP revenue, forgiven PPP revenue, is income, and therefore, if you, because the bankers, the lenders are asking for a ton of documentation, and ultimately the other part of this though is the lenders are playing a more detailed role in reviewing what you're submitting before they're approving your applications, and they are interacting with you in a more service-oriented way, asking questions and whatnot about what you submitted for your loan application. But yes, you should include that. And if having received the PPP1 money, you do not have any calendar quarter where you had a greater than 25% revenue reduction, or you don't, having included that money, have more than 25% revenue reduction for the entirety of the year, then it would be really difficult to justify your, obtaining a PPP2 loan. It is what it is, and I feel, I think I'm spot on that answer. I could be wrong, but I'm pretty confident that that is the correct answer right there. And I think, that covers most of the Q&A. So I'm just going to use a couple more minutes, guys, to just go through a couple more slides, which is, this is Section 139 of the Internal Revenue Code includes a provision that allows employers to pay employees with completely non-taxable reimbursement money for qualified emergency disaster-related costs that they incur themselves personally. This is a provision that a lot of employers don't know about, but you right now, you have the ability to take advantage of this because we are in a national disaster still to this day. And until that ends, you can take advantage of this provision. This would cover you for things such as if you needed to, if your employees all of a sudden, needed to incur emergency related costs to hire a nanny to take care of their kid because school is closed, or if they needed to, build out their personal home office, because they needed to work from home, and you wanted to offer them some form of compensation to cover some of those costs, the costs they incurred for their own personal standing desk or things of that nature. You could utilize this provision and pay for that cost to them with completely non-taxable reimbursement money through the point at which the disaster is declared to be over. So that's just something I wanted to make sure people are aware of. And then second to last item is there's some expansion of programs that came through with COVID relief. WOTC credits are extended through 2025. The extension of the exclusion from employee income of student loan payments paid by the employer is now extended until 2025. And then another provision here allows the full deduction of expenses from the employer's books when it comes to your corporate taxes on food and beverages paid or incurred to a restaurant from 12/31/2020 to 1/1/2023. Previously, this deduction was 50%. Now it is 100% of those costs are tax deductible through January 1st, 2023. Finally, we have some services that we're providing to our own customers around this, that these forms have some info on the background of the program itself. So you might find these forms to be useful just to read through. And then finally, some additional info. The IRS FAQs page on the Employee Retention Tax Credit. I'll just give you a caveat right now. There's a heading on this page which declares in big bold letters that the IRS has yet to update this page with new details based on the COVID relief bill that was recently passed. But this does have a lot of information around how do I know if I was partially suspended or fully suspended? How do I know if I've had a gross receipts reduction? It includes questions that were asked here around what if, do I include my forgivable PPP money in my 25 or my 50% revenue reduction calculation, et cetera. So this FAQs page is really useful. This blog we just published this week or last week on hiring a remote employee and the onboarding process is also very useful. And then finally, I wanted to mention, this is a New Hampshire-based company, Clean Air Curtain. I don't know if they're a chamber member yet, but I'll nudge them in that direction if they're not. We bought a couple of their devices. These are commercial grade air cleaners with UV sanitation. And I highly recommend if anybody is looking to, kind of get the gold star for making sure that you have a safe workplace for either your customers or your employees to work in. I would highly recommend that you give these guys a look. Their devices, they're not the cheapest things around, but it's given a lot of great confidence to me, my staff, and eventually when we start inviting people back into the office for visits, it will be something that will help protect us even after COVID. So that all said, my presentation is over. I'm going to shut up now, and I appreciate everybody's attentiveness. And Emily, back to you.
Josh, thank you so much for taking the extra time. And again, we are going to send the slide deck, a recording of today's presentation. He's already said you can email him. We'll have all those resources out to everyone who registered. I'm going to take just like 1 second to take over the screen share here and just give you a rundown of some stuff coming up at the chamber. We've got a lot of webinars next week. 2021 legislative preview. We're presenting with Orrin Reno. We've done a ton of webinars with them. They're very valuable. If you haven't attended one yet, definitely check this out. We have a virtual member briefing. If you're a new member or considering becoming a member, that's a great resource. This next webinar, vaccine information for employers, is going to be a really big one. We're doing this with She and Finney. It's got a lot of crucial information about how you address the vaccine in the workplace, what you have as far as options of mandating, not mandating, what employees have if they choose to not take the vaccine, or if they do want to take the vaccine and they want others in their workplace to take the vaccine. There's a lot of issues related to the various vaccines available. So this will be an overview of that. And then if you haven't tried our virtual networking events, I'm giving a plug for that. Our next one's in February. They're a lot of fun. They're a great way to just socialize and connect with people. So that's it from me. Thank you so much, Josh, and Checkmate. You guys are an amazing resource to us at the chamber, and we're so glad that we can share this information with our members as well. So thank you to everyone for joining us today.
Thank you, Emily.
All right, bye.